Hello, this is another video where I'm going to be doing some building blocks for putting deals together. And these are core concepts that when you put them all together will help you have a better framework and understanding of how to put deals together, how to analyze the numbers, and hopefully have more confidence to actually start doing more deals. And in this video I'm going to be talking about what's called a return on asset, or more commonly in real estate is known as the cap rate. And this is another really important concept, sort of a fundamental thing that you just want to understand, and it's something that I use daily in my business. And in the prior video that I hope you've watched, we talked about net operating income, or cash flow from operations. And we use those concepts here in this video to determine our cap rate or return on asset. So let me briefly go over the definition and sort of unpack it and explain it to you a little bit. Remember the concept that we have a little house, and it's just like a business. It's that individual business produces income. It rents out. You rent out the property to someone else, and it has expenses, income, expenses, and it has a net number after all that's left over, and that's your net operating income, or more what I use is a cash flow from operations. So go back and watch those videos if you want to know the difference between those two. But the main point here is there's some net figure, and this net figure is excluding any kind of debt. So no debt at this point. And this is important because I have found, both in my own experience early on as a beginner and also helping and coaching other people to look at deals, is that when you start introducing debt and leverage to any kind of analysis of a property, you're susceptible to a little bit of hocus pocus. And you can change numbers, you can increase, decrease leverage, increase, decrease interest rates, payments. There's just all sorts of variables that distract from the fact that the financing has nothing to do with the asset, the asset itself. Financing, there is a lot of profit in getting good financing, but the asset, the house, the property, is really what we want to analyze at this stage. We want to start off excluding debt, excluding financing, because it can distract you from the basic economics. Is this a good business, or is it not a good business? And that's what this rate helps us. This is a core percentage or a rate that tells us good, bad, or more accurately, it helps you compare and say, is this better or worse than other alternatives that I have, that I could invest in? So alternatives, other real estate property, or, as I'm going to show you here in a minute with this chart, even you can compare it to other financial investments. And it gives you a quantitative means of comparison. And that's one of the first purposes of understanding this building block, is that you can use it as a quantitative means to compare between properties and other financial potential investments. And so you can understand more the opportunity cost if you didn't invest in one or the other. And opportunity cost, because is if you invest in one investment at 5%, and you have another one, you invested $100,000 at 5%, and then later on you found out I could have invested that money at 10%, you have an opportunity, a real cost of 5%. So this comparison helps you understand that cost. And that's a little bit of digression there, but let's getting back to the main point, this formula. So the income that this property produces divided by, I put in quotation marks, the price. The price, and to me, includes, and then the technical definition of this includes things like your closing costs, any improvements you had to do to the property right off the bat. And so it's any costs you have for purchasing this property, your total capital investment in the property. And when you divide that by, you divide your income on a yearly basis. This is an annualized, and that's a pretty common theme for any ratios you're looking at in the financial world, an annualized ratio. So the amount of money you make every year divided by the price is your return on asset, or your cap rate. So just as an example, if I made $10,000 in my net rent for 1 year, and I invested $100,000 in the house total, my cap rate is 10%. Okay, so I think we've got that concept. Now let me show you this, because we're talking about percentages, and because yields and percentages are so important in analyzing deals or analyzing investments. I want to show you a little yield comparison chart. And I got these figures online at wallstreetjournal.com and at the S&P website. And I just wanted to show you when you can figure out a yield like this on a house you're looking at, you can start thinking about how it fits into the bigger picture. And so if you look today, and this is 2013 in August, you could get a 5-year bank CD for 1.27%. So think about what that means now. If you invested $100,000, you would get back in 1 year 1.27% of that in interest from the bank. You still have to pay taxes on that and deal with that, but that's not part of this equation, the taxes. And so 1.27%, you'd make $1,270 in 1 year with this investment. So that's how you use these yields, these percentages to figure out the real return that you're going to make. So another one, the U.S. Treasury bond, you could loan money to the U.S. government. They would pay you 1.593%, and you're committing your money for 5 years. Or you can invest your money in a S&P 500 index fund, and the dividend, so that's the portion of the profits that they give to the shareholders, would be 2%. So on $100,000, you would make just over a $2,000 return in that year. Now, it's important to understand that in these investments, especially in stocks and in real estate as well, we might have a yield from rent, and they might have a dividend yield, and investors might buy a property expecting it to be better than this yield. You might have some real estate that has a cap rate of 6% and another one at 10%, and the investor might say, my goal is a 12% yield, a total return. And so the total return on investment might be different than the cap rate, which is a snapshot in time, and it only includes our operating income. So that in the end, you could sell the property. You could have a capital gain. It's possible. The property could go up in value, and that could be another source of income for you once you sell the property. Or you could have appreciation. The rent could go up while you own the property, and so it could go up every year. The next year, your cap rate could be different, or your return could be different than this year. But the main point here is that this cap rate is something you use as a snapshot at the moment you're buying the property, and you want to use the current income that the property is producing, the current rent, to determine and compare apples with other properties, and also to compare it to what other things that have less risk do. To have a U.S. Treasury bond is a very low risk investment, whereas taking on real estate has different risk in terms of managing properties and those sorts of things. I personally, and a lot of people who buy real estate, feel much more comfortable owning that than we do owning these other ones. But that's the reason you're probably educating yourself as well. But back to my main point here is that you can compare, once you have this formula down and you can understand how to determine a cap rate, you can then compare it to other properties. And so what I would do just on a weekly basis, where this really becomes practical, is if you have 5 deals on your desk and you're looking at them, and let's say the property is listed for $70,000, and you have another property that's listed for $80,000, and you have another one listed for $100,000. And then let's say they were all in a similar neighborhood and they all rented for the same amount. They rented for, use my same number, $10,000 per year net income. You could. This is very intuitive now looking at it in this example, that the one at the lower price that has the same rent is going to be the best deal. And that's really what you're trying to boil it down to, is you have a limited amount of resources. You have a limited amount of money. Even if you're borrowing money, you don't want to willy-nilly throw your money around. You want to have a standard and have a goal. And that's my second use of this formula, is having a goal for what is a good return on asset or a good cap rate for you to shoot for with certain properties. And I have goals in certain types of properties in nicer neighborhoods, and in my kind of core farm area, I might have a goal of a 7% cap rate. And if I go outside of my area, if I'm a little bit less enthusiastic about the long-term prospects of a neighborhood, or if I think it's going to be a lot more intensive or more things that could go up and down and change, I might want to have a 12% cap rate in certain areas. And so that's how I practically use it, is by setting a goal, by comparing apples with other properties. And I'll show you a lot of other uses as we start looking into formulas and looking at other ways to analyze properties. We'll come back to this again and again. So I hope that was helpful. Hope that kind of sinks in with you. And feel free to ask me any questions by commenting on the video. I would love to hear from you. See you soon.